All right. Okay. Welcome again to the Miami Accounting webinar series. We have Brian White today. Before we get started, just a quick word. We've had some updates to the schedule, so hopefully you can see the screen. So here's a list of the upcoming. So please do keep checking back on the accounting webinar series website as we sort of fill this out. And our plan is to continue throughout the summer. So we really appreciate the support. These have been fun. We're looking forward to today. Standard rules of engagement. Brian will have about 20-25 minutes to present uninterrupted. If you have a question, there's a little sort of chat. I think there's a little chat option down the bottom in Zoom. So you can just type in your question to the chat. Me and Roman will be sort of collecting those as Brian's presenting, and then we'll call on the people asking questions during the Q&A session after Brian's finished the presentation. So other than that, I will stop sharing, and Brian, I think it's over to you.
Okay, so thank you very much. Let me share my screen here. Make sure that's working.
Okay.
Let me start the presentation. All right, so you should be seeing my slides. All right, so thank you. Let me start by saying thank you to the folks at Miami. Really appreciate the opportunity to present this work. It's been fun to engage. I've joined all the other sessions as well, and it's great to be able to continue to be able to engage with all of you. So let me get started. So this paper is co-authored with my wonderful colleagues Lisa Kuntz and Sarah Toynbee from here at UT Austin. Many of you, I'm sure, know Lisa and Sarah. Sarah actually, as you may know, is an archivalist, but fortunately we were able to bring her over to the dark side for this particular project. The name of the paper is Intangible Assets and the Justifiability of Financial Reporting Preferences in Accounting for Business Combinations. So, so much for short, snappy titles, but at least it's descriptive. So I thought I would start with this. So as many of you probably know, in accounting for business combinations under US GAAP, the acquirer is required to identify and recognize at fair value all of the assets and liabilities acquired. And so that includes both tangible and intangible assets, both those previously recognized by the target, but also those not previously recognized. And of course, any excess of the purchase price over the fair value of the net assets acquired is recognized as goodwill. Just a quick note on terminology here. This used to be called purchase price allocation, and much of the literature still uses that term. I'll probably use it occasionally. My understanding, though, is that FASB doesn't like it much because the goal is not really allocation per se, but recognition of the acquired assets and liabilities at their fair values. But one of the main difficulties in this process is the identification and valuation of intangible assets. And the difficulty arises because there are typically not observable market prices for these intangibles. And so acquirers have to rely on their unobservable, often uncertain private information to estimate fair value. And this really brings me to the statement of the problem or of our interest here, which is because of the uncertainty in valuing intangibles in a business combination, it's possible that acquirers consider something else, something that they really shouldn't, and that's their preferences for particular financial reporting outcomes when they're making these acquisition date valuation decisions for intangible assets. So what do we mean by preferences for financial reporting outcomes? Well, they might have preferences for acquisition date outcomes, like the relative amounts of goodwill versus other intangibles recognized. And they might have preferences for reporting outcomes in subsequent periods. And really key to our interest in this study is the fact that not all intangibles have the same subsequent accounting, which then provides an opportunity for acquirers to influence these subsequent reporting outcomes with their acquisition date valuation. So these day one decisions then affect the day two and beyond outcomes. So why do we think it's important to look at this issue? A number of reasons. First, it's true that intangible assets make up a large proportion of assets acquired in business combinations. A couple of recent surveys suggest that it's more than 70% in recent transactions. It's also true that FASB continues to consider changes in subsequent accounting, which could have unintended consequences for these day one valuations. We also know from some prior research that auditors may not question acquirers' valuations in this context when there's a lot of uncertainty. And then finally, the archival evidence here, while there is some, it's somewhat limited, and it's limited in part because it's often impossible to see the counterfactual subsequent accounting treatment. And so that's one advantage of using an experiment in this context, where we can manipulate the subsequent accounting while holding other things constant. So what did we do? We did 2 experiments with some very experienced accounting professionals acting as the CFO of the acquiring company. So to recruit these participants, we actually leveraged our alumni database here at UT, and our participants ended up having more than 20 years of experience on average. And I'll say a little bit more about that when I get into the details of the experiments. Their task was to determine the fair value of 2 acquired intangible assets. And then we manipulated 2 factors. The first factor was the uncertainty, or what the theory we're going to be testing here calls elasticity in the acquirer's private information about fair value. I'll also say a little bit more about the importance of private versus public information when I get into the design of the experiments. And then the second factor that we manipulated was the subsequent accounting for one of the 2 assets, which was either amortized over 10 years or tested annually for impairment. So in both experiments 1 and 2, one of the 2 intangibles acquired was developed software. And then the difference between the 2 experiments was in that second asset. In experiment 1, it was a trademark. And in experiment 2, it was goodwill. And so the purpose of experiment 2 was really to see what happens if they go about making their decisions differently when we introduce goodwill into the process. All right, let me talk a little about the theory. So the theory that we draw on to make predictions in this context is known as elastic justification theory. And it's most closely associated with a very smart gentleman named Christopher Shea from the University of Chicago. And what the theory says is that in order to make an unbiased decision, decision makers should consider relevant factors, what the theory calls relevant factors, and they should not consider irrelevant factors. So let me just say a quick word about relevance here. So in this paper, we're going to use the term relevance in the same way as it's used in this underlying theory. And that means that relevant factors are those that are, let's say, normatively or formally related to a particular decision. So they should be considered. And in our context, that means they should be considered from the perspective of standard setters, regulators, auditors. And that, of course, is different than the way that standard setters or we as accounting academics talk about relevance. The conceptual framework defines relevant information as information that could influence user decisions rather than information that should influence it as it's used here. And it's also different from value relevance, as that term's used in the archival literature, where it's used as a synonym for information that affects market prices. So that's a quick note on how we'll be using this term relevance. The theory goes on to say that although decision makers should not consider irrelevant factors, there may be certain irrelevant factors that they nevertheless want to consider. But it's also true that they don't just arbitrarily make decisions based on irrelevant factors. They have to justify it somehow. And so really the key to making predictions here is this last bullet point, which says that an irrelevant factor will have a greater influence on a decision if there's more uncertainty or elasticity in the relevant factors. So to make this a little more concrete, maybe a little bit clearer, let me give you an example that Chris Shea uses in one of his papers. So he gives the example of a traveling salesman. And the salesman is trying to decide where to travel on his next sales trip. He can either go to city A or city B. And let's say that city A has 60 potential customers and city B has 40 potential customers. This is what the theory would call a relevant factor. I mean, it seems pretty clear that if you're deciding where to go on a sales trip, you know, the number of potential customers is a relevant input to that decision. But the salesman also knows some other things about city A and city B. So he knows that city B has a whole bunch of, you know, fun, cultural and leisure and sporting activities that he really enjoys. Whereas city A is maybe a little bit more mundane. And so this is what the theory would call an irrelevant factor. But you can see that, you know, the salesman might quite like to consider these other factors in his decision. And so what the theory goes on to say is that when choices differ on the relevant factors in a clear-cut way, so for example, when the salesman knows with certainty that there are more customers in city A than in city B, then it's probably difficult to justify considering these irrelevant factors. But what about when there's uncertainty in the relevant factors? So for example, let's say the number of potential customers is not known with certainty. The salesman just has an idea of the range, and maybe the range is quite wide. He knows that there are between 30 and 90 customers in city A, between 10 and 70 customers in city B. What the theory says is that in that case, he will find it more justifiable to base his decision, at least in part, on these irrelevant factors. All right, so in our context, what are the relevant and irrelevant factors? So in the context of acquisition date fair value decisions, the relevant factor is going to be private information about the fair value of intangibles. The irrelevant factor is going to be these preferences for particular financial reporting outcomes. So the idea is they shouldn't, in a normative sense, affect the valuations, but if acquirers have preferences here, then they may be tempted to rely on them. And so this leads to our hypothesis here, which we state as acquirers' preferences for financial reporting outcomes will have a greater effect on their acquisition date fair value decisions when their private information is more elastic or more uncertain. So let me pause here before I get into the experiments and say that there are multiple patterns of results that that could support this hypothesis. And the reason is that acquirers are likely to have multiple preferences, and it's not clear which will dominate in our setting. So if you look at these two graphs, in each of them we have elasticity or uncertainty in acquirers' private information on the x-axis, and then the two lines represent the subsequent accounting conditions, where the orange line represents impairment and the blue line represents amortization. And then the dependent measure here is the amount allocated to that intangible that gets one of these two subsequent accounting treatments. And so you can see that there are different patterns depending on what the preference is. So for example, they might prefer to avoid amortization expense, in which case the high uncertainty would allow them to justify allocating more to the asset that's not subject to amortization, as in this left-hand figure. Or they might prefer to avoid impairment losses, in which case they would use the higher uncertainty to allocate less to the asset that's tested for impairment, as in the right-hand figure. But what these two figures have in common, and really the key to our prediction, is that the irrelevant factor of subsequent accounting will have a greater effect on these valuation decisions when elasticity or uncertainty in private information is high than when it's low, when they're less able to justify relying on this irrelevant factor. All right, let me talk about experiment one. So in experiment one, we had participants act as the CFO of a tech firm that was acquiring a smaller software firm for a total consideration of $150 million. They were also told, participants were told that the company had already valued the net tangible assets at $100 million. And so their task was to assign the remaining $50 million to two intangible assets. In experiment one, that was developed software and a trademark. All right. So I mentioned participants earlier. So these were UT accounting grads with at least 10 years of experience. And we sent a request for participation to 300 of them selected at random. We got a pretty good response rate, 38% response rate, so 113 responses. They had an average of 22 years of work experience. Many of them had direct experience with purchase price allocations, and they were at least moderately familiar with accounting for intangibles. So let me talk about some important factors that we manipulated, and then some important factors that we held constant in the experiment. So it's a 2x2 design, so 4 total experimental conditions, and we manipulated 2 factors. The first was the elasticity of acquirers' private information about the fair values of these assets. So in the low elasticity condition, you can see that their private information suggested a pretty narrow range of values, where the midpoint sums to 50, which was the total amount that they needed to assign. In the high elasticity condition, the range was much wider. The second factor that we manipulated was accounting for the trademark, so one of the 2 assets. And it was either amortized over 10 years or it was tested annually for impairment. And then we also held constant a number of factors. The first was that the developed software was always amortized over 10 years. And so that created conditions where the subsequent accounting was either the same or different between the 2 intangibles. And that meant that these conditions, we were creating conditions where we could observe reliance on preferences for financial reporting outcomes, because the accounting was either the same or different. The second thing we held constant was we told them to assume that part of their bonus was based on net income. And so that creates incentives for higher earnings. It creates a context where they're likely to care about income statement outcomes. And then finally, we told them that their outside audit firm would accept any allocation in that wider range, so the range from the high elasticity condition. And we did that because we didn't want them to infer that their private information was informative about the public information set. Because if they did that, they would be constrained by possible external penalties, rather than by their private information, which is what our theory would suggest. All right. So this was the pattern of mean valuation decisions for the trademark across the 4 conditions. So as you can probably see, somewhat surprisingly, we don't see an on-average effect of subsequent accounting here. Recall that the 2 figures over here on the right-hand side are the 2 possible patterns of results that we thought we might see, but we actually didn't end up seeing either of those. So in thinking about why we might not see an on-average effect here, we considered the possibility that these preferences for avoiding amortization expense and avoiding impairment losses might both be there, but be offsetting one another on average. And so to see if that was actually what was going on in our data, we did a couple of other tests. So the first thing we did was to look at some written responses to a question where we asked participants to describe the factors that they considered in their valuation decisions. And so we then, and this is just some examples of the types of responses that we got. We classified the factors that they mentioned as being either relevant or irrelevant, using those terms in the same way as we talked about earlier. So relevant factors were references to the ranges of values that represented their private information, whereas irrelevant factors were those that referenced some reporting outcome, like higher future earnings or the risk of future impairments. And then we analyzed those by condition, those responses by condition. So probably unsurprisingly, a majority of responses did reference the acquirer's private information, in other words, those ranges that they were given. But more interesting was that participants were more likely to cite an irrelevant factor, so future reporting outcomes, in the impairment high elasticity condition, which is exactly what we would predict if they're using the uncertainty in their private information to justify relying on their preferences for reporting outcomes. So then the second thing we did was to look at the dispersion of results across the 4 conditions. And when we did that, we found that there was that when there was greater uncertainty in acquirer's private information, the subsequent accounting led to more variation in their responses. So this combination of written responses and dispersion results suggests that they are considering financial reporting preferences when their private information is uncertain, but their preferences for reducing amortization expense and avoiding impairment have different directional effects that are offsetting one another on average. So, which is a plausible explanation for why we don't see an overall on average effect for our valuation results. All right, let me talk briefly about experiment 2. I know I'm running a little short on time, but experiment 2 is important because it was designed to see what happens when we introduce goodwill into these valuation decisions. So everything was exactly the same as experiment 1. The setup was exactly the same, except that the second asset here, instead of being a trademark, was goodwill. So participants very, very similar. We just did another random draw of 300 from our pool of UT Austin accounting grads. So everything looked very similar. So let me just get right into the results. This was the pattern of results. And of course, there's lots to dig into here. But the first point is that our hypothesis is more obviously supported by this pattern of results. So we do see an effect of subsequent accounting when elasticity or uncertainty is high. So over on the right-hand side of the graph here, we see these subsequent accounting lines diverging. But on the left-hand side, when uncertainty is low, they can't justify relying on the subsequent accounting, and so we see no effect of subsequent accounting there as we predicted. The second point is that we see acquirers assigning a higher value to goodwill when it's tested for impairment than when it's subject to amortization. And so they do seem to consider a preference for avoiding amortization expense. In other words, the orange line is higher than the blue line over on the right-hand side of the graph here, as we would expect if they have the preference for avoiding amortization. But it's also true that these results don't look exactly like either of these patterns up here, because they're not using the greater elasticity to increase or decrease the value of goodwill when it's tested for impairment. So in other words, we don't see this orange line sloping up or sloping down. Instead, it looks like something else is going on. And the something else is that they seem to be using the greater elasticity to assign a lower value to goodwill when it's amortized. In other words, when there are no earnings effects, no future income statement effects of their allocation. And so that suggests another ceteris paribus prediction based on a preference to minimize the value of goodwill on the balance sheet. And if that were all that was going on, we would just expect two straight downward sloping lines here. Of course, we don't see that. We see this interactive pattern. And so putting it all together, it seems that acquirers are relying on elastic justification to make their valuation decisions. And specifically, when uncertainty is in their private information is high, they're basing their valuations on preferences related to minimizing goodwill and also to avoiding amortization expense. It's a little less clear whether they also have preferences for avoiding impairment losses here because it could be contributing to the flat line in the impairment condition, but we don't have definitive evidence of that. Certainly they did show some evidence of that in experiment 1. So overall conclusions before I get to questions. We find that acquirers use the elasticity or uncertainty in their private information to justify relying on their preferences for certain financial reporting outcomes when they make acquisition date fair value decisions. And in particular, they consider these three distinct preferences. So preferences to reduce future amortization expense, reduce the risk of future impairment losses, and to minimize the value of goodwill on the balance sheet. All right, sorry, I think I went a little bit over, but that's all I've got in terms of the planned portion of the presentation. I look forward to your comments and questions.
Thank you, Brian. I think first question was DJ. Go for it.
Okay, Brian, so my question is really one that's outside the scope of your experiment, but dealing with the central idea of why would we see sort of this heterogeneity in financial reporting outcomes post-acquisition. So one sort of rational sort of Bayesian story is that if you have people with heterogeneous preferences who are making acquisitions and there's uncertainty about the target, you know, we have the winner's curse at play. And so when there's greater uncertainty about the target, the person who's most bullish is going to make the biggest error in making the acquisition, and ex post, you're going to see the same problem with the financial reporting because they'll probably have to take the biggest impairment. right? Now, in your case, you're not looking at heterogeneity in acquisition decisions at all. You're giving your participants, your subjects, the acquisition.
Yeah, so I'm trying to think about how this you know, how this would relate to you know, how I think what you're suggesting is overpayment, right? There's overpayment
Right.
on average, and so how would that play out in how would our theory kind of what implications would our theory have for that? You know, I think if your main concern is avoiding future impairments, right? Because you know you overpaid, and so you're worried that there's some future impairment coming. You know, then what our theory would say is, you know, if there's sufficient uncertainty about these values, then you would prefer to do your allocation in some way that allows you to avoid future impairment. So for the assets that are tested for impairment, you would likely under allocate to those assets.
Right. Right, that's correct.
Yeah, actually, I'll quickly jump on board here as well. I had a similar question, which was, given it is an allocation of the purchase price to some extent, does that mean that the managers overall were pretty confident in the total fair value, like in what they actually paid, and then the uncertainty, right, is about how to allocate across individual intangibles? Or does that uncertainty play into the initial purchase price to begin with?
Yeah, I think it's a really good question, and this is I've presented this paper at a few workshops. This question like this usually comes up. You know, I think there is kind of a disconnect here between the way in which business combinations happen and then the way that we account for them. So, you know, I don't think when an acquisition is being negotiated, I don't think there is much thought given to you know, what specific assets are we getting, and what are the fair values of those assets. Now let's sum them up, and that's going to be, you know, the maximum price that we would pay for this target. You know, I think it's much more. Well, first of all, I think it starts with something like, you know, discounted cash flows or residual earnings or something, valuing the enterprise, and then it's the product of a negotiation. And so, but then, you know, of course, when you get to the accounting for it, then we say, well, you can't just value the whole enterprise. You have to look at the individual assets. And so, I don't know if that answers your question, but I do think that there's this disconnect between the way that the purchase price or the total consideration is arrived at, and then how we account for it.
Yeah, I mean, I guess you're kind of considering it almost like a two-step process here, where what we're talking about now is the uncertainty about where you're going to put this stuff, because the accounting makes you allocate it to some extent.
Yeah, and it's,
unless you're just going to throw it into goodwill, which is
right. And it's but I think, you know, one of the things that's kind of that's in the background here is that there tends to be a lot of uncertainty about the value of the individual assets too. So, you know, there's probably uncertainty in how much the total enterprise is worth. But even then, when you get to the second stage, there's varying amounts of uncertainty in the value of the individual assets as well.
Thanks. I think next we have Natasha.
Hey, Brian. So one of the things I noticed is that the predictions appear to be pretty consistent with what we'd expect with motivated reasoning, where these decision makers are just kind of more likely to behave in a way that's consistent with their preferences when they can justify doing it. So I'm wondering if the paper would actually benefit from relying on that instead of on the elastic justification, since the motivated reasoning is a little less specific, and then it wouldn't really require you to make the distinction between what the decision maker sees as relevant versus irrelevant information. We wouldn't have to make that normative statement.
Yeah, I mean, certainly the theories are related. So, you know, for people who are not familiar with motivated reasoning, it makes similar predictions. You know, it basically says that, you know, we when we have a particular directional preference or directional goal, we engage in a biased processing of information to arrive at a conclusion that's consistent with that goal. I think there is some similarity here. What's the key difference? I think you put your finger on it when you said, it talks about these relevant versus irrelevant factors. I guess we just think that this is a little bit better fit here because we do have relevant factors. I mean, we know from like FAS 157, or I guess it's ASC 820, that we know how we're supposed to do fair value, right? And in estimating fair value, we're not supposed to be relying on future preferences for future reporting outcomes. And so I think what's a little bit unique here is that this theory talks about uncertainty in these relevant factors, whereas motivated reasoning might just talk about uncertainty in a more general way. And so would we come to the same particular prediction with motivated reasoning? It could be very similar, but we thought that the elastic justification was just a little bit of a more precise fit here.
Thanks.
Next we have Ryan.
Hi, Brian.
Hi, Ryan.
Good to see you.
I can actually see your face. I can't see everyone's face on here, but you happen to be in my Hollywood squares here.
I'm honored. So I was just wondering with E1, have you had a chance to split the data based on some of those justification results? I mean, I wouldn't expect any kind of significance with the kind of lopsided small cell counts, but do you see any kind of the pattern of those predicted ordinal interaction shapes for the valuation DV?
When you say the justification results, what do you mean?
As far as the written coding, so do you end up, because you've got people then being able to say what drove their decisions?
Yeah, we haven't. I mean, you can see, I think you mentioned it. I mean, you can see the issue with this. Like if I go back, if I go back to that slide, or this slide, I guess it is, a majority actually reference the relevant factor, right? And so right there, we're kind of, we've got a large proportion of the data that we would not be expecting to see relying on these irrelevant factors. And then in the other cells, there's one cell in which there's no one, right?
Yeah.
There's no one relying on or mentioning a future reporting outcome. So if there's, there may be some way to look at that, but the short answer is no, we haven't done it.
I had a feeling that was the case based on, the way you kind of described how those laid out. One thing that alternatively that you might want to consider is, right after the hypothesis, which is a pretty general hypothesis, which is fine. There's, there's the paragraph that talks about how, you don't make anything more specific because of, a more specific pattern of results prediction because, there's multiple things going on, and that totally makes sense. But through the results section, there's a lot of talk about patterns of results. And I understand why that's the case, because yes, there are individual sub patterns of results that do make sense according to the theory, right? But when right after that hypothesis, you're kind of, it feels like I'm not expecting to see that types of things, but then all of a sudden, as you read through, it's like, well, there's this pattern, there's this pattern, there's this pattern. So some more like motivation for things like the exactly what you'd expect to see with the dispersion analysis, and those types of things as you go through might make it easier for the reader to not have it look, kind of like a capitalizing on chance situation, which I don't think it is. It's just that a general hypothesis leads to general testing, and the omnibus tests here don't work, right? Yeah,
I think it's a fair point. On the ex post thing, yeah, I mean, I think we did expect to see, one of these patterns that I put up here. Sure. We expected to see one of these, honestly, in experiment one. We expected, for there to be a dominant preference here for either avoiding amortization expense or avoiding impairment losses. And we ended up not seeing that. And so, had we seen that, we probably wouldn't have dug into the data as much as we did. But, so, I guess this is there's a long way of saying, yeah, some of it was ex post, right? It was ex post because we didn't see an on average result that obviously supported our hypothesis in experiment 1.
Oh, and I want to be clear, I don't think you learn anything less from that at all. And I think that especially, and this is one of the situations where it's clear that, that E1 happened, right? And then, you dug into it and learned more. And I think that's a good story. I mean, you did it and you learned more and we can go forward. It's just making sure that I think that people who are, I think more sensitive to that can, kind of know what to expect as they're coming through the results section. I think we'll just probably do you some favors.
Yeah. Yeah. That's helpful. Thank you.
No problem, Ryan. Good luck.
Thanks.
Thanks. Actually, Jeff, I know you had a follow-up point to DJs if you wanted to chime in. Otherwise, we can.
Sure. Yeah. Can you hear me okay?
Yep.
Yep.
Yeah. I had a similar thought when I was thinking about the implications for this study. We're looking at the research on the winner's curse, and but one thought on that is that the winner's curse is much more problematic when you have a common value asset, because there the private information has to be severely discounted in order to account for what is implied by other people's information when you buy it. That's not as big of a problem when there's idiosyncratic values for an asset. And so if there's a synergy or something like that, then the implications could also be that you have the strongest possible synergy for utilizing an asset. And since the fair value is a function of what the market's best alternative would be, that actually wouldn't mean that the fair value is supposed to be different, just depending on who acquired it in some way. So, I hadn't really thought about how to take that to your setting, except to think that, it's possible that those assets being acquired may actually have some synergies, and so you might think about that way. I did struggle generally with kind of the question about why so much a focus on private information. What? Yeah. Yeah.
Well, so I'll address that. Thanks for your comment as well. But so why the focus on private information? I think it's because if this is just about uncertainty generally, then so in other words, let's say that the ranges of private information, they weren't just ranges in the acquirer's private information, they were generally known, right? So so the idea there with them would be that they're not constrained in their valuations in the low elasticity condition because they don't find it to be justifiable to themselves. It's just that they can't get away with it, right? So I think it's a somewhat less interesting story if these differences in uncertainty are publicly known.
Yeah, so that I think some language around that maybe early on might help, because it's not distinct to the location of the uncertainty, but it does sort of change the implications for whether you could clearly interpret their results as being somewhat strategic or self-serving, as opposed to
yeah. I mean, I think that's exactly right. If the level of uncertainty was widely known, then this could just be interpreted as strategic behavior, and we don't think that's what's going on here. I mean, I think we might see similar results, but the explanation would be different. Our explanation based on this theory is that the low elasticity, the low uncertainty, and the private information makes it difficult to justify relying on these irrelevant factors to themselves, rather than difficult to justify it to someone else.
Yeah, I think it does go back to this, still the difference between common value assets and idiosyncratic ones, where there could be some strategic alliances. It could be publicly known that we think there's a lot of potential. This could be a big boon for our company or a total bust. You might, even if that was known, that might still play out in a very similar fashion. But again, I get what you mean by the clarity around what you could infer changes.
Thanks.
Thanks. We have next we have I think Shinyu.
Hi, Brian. Nice to
Hi,
see you.
Shinyu.
Hi. So my question kind of relates to Ryan's point is I can see the paper has two main pieces. One is how people react to whether people rely on their preference given different uncertainty. And then the second piece is what exactly are these preferences? And my feeling is like right now, we can only observe their preferences in the high uncertainty condition and then based on some additional analysis. And so I wonder whether like down the road, would you consider maybe have a separate piece like a survey to just better understand or directly understand their preferences and then even consider manipulate those preferences to have like clear results for the first research question?
Yeah, I mean, I can't say it any better than you did, actually. I think that's exactly right. There are two pieces of this. One, does the uncertainty allow them to rely on their preferences? And then the second part, and this is one of the reasons we used experienced participants, is that we wanted to see exactly what those preferences were. So yeah, we are considering doing something next. Actually, it's not it addresses part of what you said. We say in the paper that putting together the results of experiment 1 and experiment 2 suggests that there's something unique about goodwill here, right? There's something different happens when you introduce goodwill into the valuation process. That's true as far as experiments 1 and 2 go, but it's also true that we're just comparing goodwill to a trademark, and so it's probably a little strong to say that there's something unique about goodwill. There's something different about goodwill in experiment 2 than we see when goodwill's not there in experiment 1. So we are designing a survey currently to make that point a little stronger, to really show some more evidence that there is something unique about goodwill, and it's not just compared to the trademark.
That's awesome. Thank you.
Thank you.
I think next we have Blake.
Hey, Brian, can you hear me all right?
Yep, I can hear you.
Yeah, so I think, if you're incorporating a survey or something like that, I think you've kind of answered my question a little bit on kind of what these sort of cross-sectional differences might be. Because I'm trying to think of, if we have non-uniform preferences, if there's a way that we can kind of at least form an expectation about what those preferences might be. And I guess, maybe to just kind of take that a step further, I'm sort of trying to understand what the practical implications of the paper would be, because right now it has very much like a theoretical bent to it. It's very, just trying to understand these factors that, influence managers' decisions. And so I'm trying to think, because their preferences and the uncertainty of their private information are both kind of unobservable. I mean, is there, if you know these preferences, I mean, would you maybe suggest that you can infer from their actual reporting decisions how certain their private information is, or it's just kind of, where's kind of the angle that you're sort of trying to take this if it's going sort of beyond that theoretical space?
Yeah, I mean, I think we start from the premise that generally the uncertainty is quite high in the value of these intangible assets. And so it's a setting in which you're likely to see acquirers relying on these irrelevant factors, on these preferences for reporting outcomes. And so to a certain extent, the low uncertainty condition or the manipulation of uncertainty just allows us to see the preferences, right? It allows us to see how the uncertainty leads to the reliance on these preferences. But the second part of your question about practical implications, I mean, I think the way that we kind of got into this was, thinking about standard setting and the changes that are happening there. There's an exposure draft out at the moment where the FASB is thinking about some additional changes to subsequent accounting for goodwill and other intangibles. And I think one of our purposes in writing the paper was to say, if you change the subsequent accounting, you may not be thinking about the valuation date consequences, but the subsequent accounting actually is likely to have some consequences for the valuation date, the acquisition date valuations. And so I think in terms of practical implications, I think our thought is that this is informative to the FASB and maybe the IASB too about what those implications might be if they were to change the subsequent accounting.
Yeah, and I think once you have the survey in there and you can kind of speak more directly to what those preferences are and how they're likely to show up, I think the implications might be a little bit more clear then. So, great, thanks.
Thanks, I appreciate it.
Next we have Christy.
Hey, Brian.
Hi, Christy.
So right now the paper is very much motivated by the case where there's high uncertainty in the value of an intangible asset. And to me, that seems like it creates at least two potential issues. So first, when you read the paper, it feels a lot more like prior earnings management literature, or in other words, managers are going to respond to their incentives to achieve certain reporting goals when they're able to. And I think that kind of undersells the contribution of your paper.
Okay.
I think the second issue is it's arguably not all that common. So yeah, there's a lot of uncertainty in the valuation of intangibles, but acquirers come up with pretty narrow estimates in order to decide how much to pay, at least for the intangibles that are big enough or a big enough component of the purchase to be material. So I agree there's some intangibles that you kind of don't think of individually, but for the ones that are important, they're going to assign a pretty precise value to decide how much to pay. So yeah, there's uncertainty and they might not get it right, but once you get to deciding what to assign for financial reporting purposes, a lot of that uncertainty should have already been resolved in their own minds. And so I guess what I feel like is that maybe the low uncertainty cells make a bigger contribution to the literature than you're giving them in the paper, even if you don't find significant differences there. In other words, it seems very interesting to me that managers' private information almost psychologically ties their hands and keeps them from misreporting. So I guess I would just, it's not really a question so much as an encouragement to at least consider whether to place more emphasis on that in the paper. And I think that'll make it, tying back to Jeff's point, I think it'll make it clear then why private information is a big deal, because it's a bigger deal when there's a difference in the uncertainty between managers and auditors or other people evaluating those numbers. And then it also lets you get around the issue of whether the high uncertainty condition maps to reality, because then it's more of a comparison condition, I think. So just something to consider.
Yeah, I appreciate that. I think we have struggled somewhat with how to talk about the low uncertainty results, because I think you're right. I mean, I think actually maybe those are the surprising results, right? You know, we explicitly tell them that your auditor and by extension everyone else would be fine with something in the higher range, and so you know they could get away with what they do in the high uncertainty condition also in that low uncertainty condition, but they don't, and they don't because they're constrained psychologically by the low uncertainty in their private information. But yeah, so I appreciate the encouragement, because I think we have struggled to really make more of those results.
Sorry, and Lisa has a question.
Sorry to do this to you, Brian, but it's actually not a question for you, but it's to everyone else. Brian talked about the additional data that we were going to collect for the survey. It was about to happen right before all this transpired, but I know there's a number of experimentalists in the audience, but anybody's opinions on that, because it's all ready to go for the most part, just needs to be mailed out.
Yeah, I mean, thoughts on whether it's a good or bad idea to send it out right now. I mean, I'll give you my thoughts on collecting data generally around this time. And when this first happened, my advice to our doctoral students was, we probably shouldn't be collecting data because we don't know how just the general uncertainty around this time and fear and everything else is going to affect our results. And I know there was a case here where this is years ago, where someone, a doctoral student, was collecting data, and right in the middle of this, 9/11 happened, and those results were affected. You could actually see the difference in responses before and after 9/11 happened. So so my general thought when the coronavirus first started and lockdown was happening and everything was that we shouldn't be collecting data. I'm a little less certain now because this has gotten to feel somewhat normal. I mean, I think when Miami started doing these webinars, it all felt pretty weird. Everyone's sitting at home and participating in these workshops, and at least for me now, it's gotten to feel pretty normal. And so maybe it's less of a concern now.
Feel free to just unmute and discuss if you had something to add to that.
Yeah, I was just going to say, I think you're exactly right. I think we're getting to this new normal people, still stressed, but maybe a little bit less stressed. So the time goes on, maybe like in a month or two. Maybe this shouldn't be a big of an issue.
Yeah, I think people are looking for things to do at home too. That they, they may actually have a little more time now than they used to.
Yeah, Brian and Lisa, to that point, I was wondering for a survey especially, I wonder about how the attrition would be different than normal times and about the non-randomness and attrition, especially with the fact that your theory deals with uncertainty. And so I don't know. What scares me is I don't have a prediction. And so that, that's kind of what my only concern with that. I think a normal experiment, to the extent that there's no interaction with the manipulation, I'd expect probably more random variance, but a survey is a little bit different.
Yeah, and so I agree with you. I mean, I think we would be hesitant to run experiment 1 or experiment 2 right now, but this is really a survey. I mean, this is following up to see generally how people think about goodwill compared to other types of intangibles. Maybe I can just ask Blake actually, if you're still there. You said something about cross-sectional results, and so are you suggesting that it would be useful to kind of get some data on industry or how people are compensated, that kind of thing?
Yeah, I think that might be helpful. I mean, if you have it, I think it's probably worth looking at even just for an initial sanity check. I mean, granted, if you're really only seeing those differences kind of manifest within that one cell, I don't really know exactly how reliable, an inference based on that small size is going to be, but I mean, at least might kind of give you an idea of what to look for, figure out who your population should be, if you need to be looking for equal numbers maybe of public and private company alums, how much experience they have. So it's probably an okay place to start while you wait for more comfort over what the survey data is going to look like. But yeah.
But the one thing with the survey data is, it's plausible that risk preferences have changed in this post-COVID world. So, and how people perceive acquisitions has changed. We have politicians out there saying we need to ban all mergers and acquisitions. So that perception, I don't know how informative it is of your experimental results.
Yeah, I mean, I think it's a good point. And I think this is exactly why we were hesitant to do it when this first happened. And I haven't seen, and please anyone chime in if they have seen, I haven't seen any data on like how risk preferences have changed. It would be great if there were some.
Actually, there was a report out just this morning about savings rates are skyrocketing. People are just sitting on their money,
which suggests higher risk aversion.
Yeah, even though interest rates are the lowest they've been, people just don't want to spend money.
Brian, can you hear me?
I can. Is that Dan?
Yeah, that's me. Hi.
Yep.
One thought I would have on that survey, and this isn't this is not foolproof by any means, because surely this thing is going to affect responses no matter what you ask people. But you could try, if you have experienced participants who have, and you say in here that they have prior experience choosing these valuations and dealing with these combinations. I mean, you could specify in a survey in the past rather than asking them, what would you do right now? Like, what did you previously consider? Now, again, that's not foolproof because people, you know, even in recall, like, you know, when you're rebuilding and recalling memories, current situations can certainly impact how you recall things. But right. It might be by specifying time frame to what have you previously experienced, that could be one way to avoid, you know, the risk assessment issues that come with COVID-19.
Mm-hmm. Mm-hmm. Better than nothing, I guess.
Yeah.
Yeah. Thanks. That's helpful.
Brian, just to add on that, I also feel like to the extent that we believe COVID-19 has like a persistent impact on everyone's life, and this is a new normalcy now, if there is a shift in risk preference, it's fine. We'll just observe a new level of risk preference. And because this is not related to experiment 1, experiment 2, it still tells us something of how people view goodwill and have these preferences. Yeah. So
are you saying? I mean, are you basically arguing that you know a shift in risk preferences, you know, might kind of have a main effect on these things, but not on the pattern of results? Is that, am I understanding right?
No, my main feeling is no matter what results you get from these surveys, that will reflect how people really feel at this point. And even if we say, reviewers say COVID-19 has impact, but COVID-19 has impact on everyone and probably will have lasting impact. And so this will reflect the real how managers feel like. So right. It may not even matter that much how they feel before. This is the new reality.
So in other words, I think, I can't remember who it was who made this point, but the kind of two pieces of the study are that, you know, the effect of uncertainty and how uncertainty allows for preferences to influence these valuation decisions. You know, that's the kind of main takeaway from experiments 1 and 2, and then this kind of post-COVID survey could tell us about the second piece, which is what are those preferences, and maybe we could even learn something to Blake's point about, you know, how they differ based on compensation, based on industry, et cetera. Yeah, I think that's a very helpful point. So thank you.
Yeah, thank you.
All right. I think if we got a minute or so left, we might leave it there unless someone else wants to interject. But all right. Otherwise, thank you very much. Brian,
yeah, thank you everyone. Really enjoyed it. Thank you guys, the Miami guys. I really appreciate you guys doing this. It's been really fun.
And thanks obviously for everyone for attending and participating and supporting. I think we have Jennifer Bluen next week. And yeah, please do keep checking the website as we'll keep updating. Thanks again, and everyone take care.
Thanks. Bye, everyone.
Thank you.